So looking at Micron Technology, ticker symbol MU, as of April 20th, 2026,
Right.
are we seeing like a falling trend flashing massive sell signals? Or is this a strong buy that some Wall Street analysts are somehow still calling deeply undervalued?
I mean, that really is the billion-dollar question right now.
It really is. And that's exactly what we're tackling today. We are going to cut through the absolute mountain of noise to find out what is actually happening under the hood of this stock. And, before we jump in, if you want more deep dives like this, where we just skip the fluff and get straight to the facts, make sure to hit that like button, subscribe to our YouTube channel, and definitely leave your comments and feedback below. We want to hear from you.
Absolutely.
So let's lay out the mission here. Today's deep dive is exclusively focused on Micron, and we have a massive stack of sources for this one. We're talking income statements, balance sheets, technical charts, insider trading log.
Oh, yeah, the insider logs are fascinating on this one.
Totally. And, market forecasts. The goal is to figure out the truth here.
Yeah, so to orient us right out of the gate, Micron is currently trading at $455.07.
Okay.
It was down a slight, 0.47% in the latest regular session. But zooming out is where the picture gets really wild.
Right. The broader context.
Exactly. This stock is up an absolutely staggering 59.4% year to date. And if you look at the past year, it is up 561%.
I mean, 561% in
Oh.
12 months.
Yeah.
That's the kind of number that usually makes me think something is broken in the matrix. Like, it doesn't even sound real.
It's historic,
Yeah.
honestly. But it is crucial to understand that this isn't a typical stock movement based on, a few good quarterly product cycles or a clever marketing campaign.
Right.
What we are witnessing is a massive fundamental repricing of the entire company.
Okay, let's unpack this. Because to understand how a massive hardware company climbs 561% in a single year, we really have to look at the actual mechanics of what they're selling.
You have to look at the underlying math.
Exactly, because you can't just run a stock on hype forever. Eventually, the math has to work. So think about it like this for everyone listening. If these massive AI server farms, the ones running ChatGPT and whatever else.
The big data centers.
Right. If those are giant rocket engines, high bandwidth memory, or HBM, is the high capacity fuel line.
That's a great way to put it.
Without Micron's memory, the AI boom literally starves. Because the processors, no matter how fast they are, they just cannot compute if they can't access the data fast enough. But what actually makes HBM so different from the regular RAM sitting in my laptop right now?
Well, the best way to visualize it is to think about real estate, actually.
Real estate, okay.
Yeah. Traditional memory chips are like sprawling suburban neighborhoods. Data has to travel across a relatively long, flat distance to get to the processor.
So it's a long commute.
Exactly. And that takes time and consumes a lot of power.
Yeah.
But high bandwidth memory changes the architecture entirely. It's like building a massive skyscraper right next to the processor.
Oh, wow. Okay, so going vertical.
Right. They physically stack multiple memory chips vertically on top of each other and connect them with these microscopic wires. This drastically shortens that data commute.
That makes total sense.
So the processor can access vastly more information incredibly quickly and with much better energy efficiency. And right now, training AI models requires moving just oceans of data back and forth constantly.
So they essentially solved the biggest traffic jam in computing.
Pretty much, yeah.
And when we look at the financial fuel coming in from solving that traffic jam, the numbers are truly record-breaking. Let's look at the trailing 12 months, the TTM income statement.
The revenue jump is just bonkers.
It is. Total revenue hit approximately $58.11 billion.
Yeah.
And to put that in perspective for you, in 2024, their revenue was $25.11 billion.
So they have more than doubled their top line in an incredibly compressed time frame.
More than doubled. That is wild for a physical manufacturing company. It's one thing for a software startup to double revenue.
Just selling more licenses, yeah.
Yeah, right. But having to physically build twice as much high-tech hardware is a totally different beast.
And what's even more impressive than that top-line growth is the profitability. So gross profit sits at roughly $33.96 billion.
Wow.
Which translates to a massive 58.4% gross margin. Now, to understand why this is a true aha moment for investors, you really have to look at the history of the memory chip business.
Okay.
Because historically, memory has been a pure commodity. It was like farming corn. A gigabyte of RAM from Micron was essentially the exact same as a gigabyte from Samsung or SK Hynix.
And when you sell a commodity, you have basically no pricing power.
Right, which leads to razor-thin margins and these brutal price wars.
You just sell at whatever the market price dictates that day, right?
Precisely. But HBM has completely flipped that script because HBM is incredibly difficult to manufacture, and the demand from companies like Nvidia is so astronomical, there's a severe supply shortage.
So Micron isn't selling corn right now.
No, they are selling bespoke diamonds. That temporary shift from a commodity supplier to a highly specialized bottleneck has given them immense pricing power.
And that is how you get a 58% margin on a physical piece of hardware.
Exactly. And it trickles down. Net income is at $24.11 billion, which brings their diluted earnings per share to $21.19.
I mean, those are software company margins. It's just incredible. And the balance sheet completely reflects this windfall, too. Looking at the data from February 2026, Micron has $101.5 billion in total assets.
Yeah, a massive asset base.
And almost $14 billion of that is just sitting in cash and equivalents. On the flip side, their total liabilities are just $29.1 billion, with long-term debt at only $10.2 billion.
Which is very manageable for a company this size.
Totally. That leaves a remarkably robust shareholders' equity of $72.5 billion. It's an absolute fortress.
It is a phenomenal balance sheet. I mean, they have the war chest required to weather almost any macroeconomic storm that comes their way.
But wait, I do want to push back on something here because this is where the math gets a little complicated for me.
Okay.
Let's look at the cash flow. Micron reported a record $6.9 billion in free cash flow in fiscal Q2.
Right.
That sounds great on the surface. But they also reported spending $5.0 billion in capital expenditures, or CapEx, in that same exact window. So they generated nearly $7 billion and then immediately burned $5 billion of it just to build out capacity. Are they spending this cash way too aggressively?
Well, it sounds aggressive to anyone outside the industry, sure. But in the semiconductor world, it is the absolute cost of admission.
Really? $5 billion a quarter?
Yeah. Fabrication plants, or fabs, are arguably the most complex factories on the entire planet. The machines that print these memory chips, these EUV lithography machines, they cost hundreds of millions of dollars each.
Just for one machine?
Just for one. And they require pristine clean rooms, vibration-free foundations, massive amounts of power. You have to spend billions today just to secure your dominance 3 years from now.
I see.
So while $5 billion in a single quarter is a massive outlay, it's actually their lifeline. They're building the physical infrastructure required to meet the anticipated 2026 and 2027 demand.
Because if they decide to just save that cash instead...
Then Samsung will happily spend it, and Micron will lose their market share practically overnight.
So it's a relentless arms race.
Very relentless.
Okay, so if the company is making historic profits, margins are sky high, and they're spending heavily to secure the future, we need to look at what the people closest to the company are actually doing with their personal shares.
Yes, the insider activity.
Because the insider trading logs from April 2026 really caught my eye, and they paint a very different picture.
They do look a bit alarming at first glance.
Right. We have Executive Vice President Sumit Sadana selling $10.1 million worth of stock at 421.35 cents. And we also have Executive Vice President April Arnzen offloading $13.9 million at 347.39 cents.
Yeah, and that kind of data often spooks retail investors.
I mean, if the stock is such a strong buy, why are the insiders cashing out millions? People see executives selling and naturally assume the ship is sinking.
Exactly. But what's fascinating here is, if we connect this to the bigger picture, it usually tells a story of simple portfolio diversification.
Okay, how so?
Well, if you are an executive who has been receiving stock options for a decade, and the stock suddenly runs up 561%, your personal net worth is likely dangerously overweight in Micron stock.
Right, all your eggs are in one very volatile basket.
Exactly. Selling $10 million or $13 million is often just a rational financial planner telling them to take some chips off the table.
Okay, I hear the diversification argument all the time, but I have to push back here. $13 million is a whole lot of diversification.
The big number, yeah.
Right. If these executives truly believed the stock was going to hit $850, like some of the bullish analysts are saying, wouldn't they hold out for double the money? Are we absolutely sure this isn't them seeing a market top that we are somehow blind to?
It's a valid skepticism. Insiders certainly know the internal hurdles better than we do. But the real counterweight to that insider selling is what the institutional money is doing.
The smart money.
Right. While a few executives are taking profits to buy houses or, diversify, institutional accumulation remains incredibly strong.
Oh, really?
Yeah. The big money hedge funds, mutual funds, pension funds, they are stepping in. and aggressively absorbing every single one of those shares the insiders are selling.
So they're just buying up the supply.
Exactly. Analysts right now are giving MU a consensus rating of strong buy. The average 12-month price target is $533.72.
Okay.
And the high-end estimates, they're reaching a staggering $852.
$852. That would nearly double the current price, again, on top of a 561% run.
Yeah, the math is crazy.
That essentially means Wall Street institutions are looking at an executive selling $13 million worth of shares and saying, thank you, we'll take those off your hands. We think they're going way higher.
That is precisely the dynamic. Institutions play a completely different game. Their time horizon spans years, and their capital scale requires them to buy when liquidity is high.
So an executive selling a block of shares provides exactly the liquidity a pension fund needs to build a massive position without driving the price up too fast.
You nailed it.
All right, so the fundamentals are booming. The balance sheet is a fortress. The institutions are buying the insider sales, but, institutions might be happily buying up those shares based on a long-term thesis, while Wall Street's trading algorithms don't care about human optimism.
They only care about the math.
Right, they care about the math. And right now, the math on the technical charts is showing us a very specific bottleneck. So let's decode the charts.
That's it.
We noted earlier it cooled off slightly, down to $455.07. That is a pullback from its 52-week all-time high of $471.34, which it hit back in mid-March.
Yeah, but a cool down after a 561% run is completely healthy.
Right, it can't just go up in a straight line forever.
Exactly. What really matters is that it is still trading well above its 50-day moving average of $436.47 and comfortably above its 200-day moving average of $406.94.
Okay.
Staying above those moving averages confirms that the broader medium-term and long-term uptrends are still very much intact.
But if we want to look at the immediate momentum, like what happens next week, we turn to the indicators, and the data shows the 14-day RSI is sitting at 56.44.
Yeah.
Now, translate that from Wall Street to English for me. What is that actually measuring, and why do we care about the number 56?
Sure. The RSI, or Relative Strength Index, measures the speed and magnitude of recent price changes. Think of it as a speedometer for the stock.
A speedometer, okay.
Yeah. If the RSI goes over 70, the stock is considered overbought, meaning it ran up too fast, the engine is overheating, and it is likely due for a pullback.
Makes sense.
And if it drops under 30, it is oversold. So a reading of 56.44 is sitting right in the middle, leaning slightly bullish.
But it's not overheating yet.
Exactly. It tells us the stock has strong forward momentum, but it isn't dangerously overbought. It has plenty of room to run before hitting that warning level.
And the other indicator the sources flag is the MCD, using the standard 12 and 26 periods, which is sitting at 6.8.
Right. MCD stands for Moving Average Convergence Divergence.
A mouthful.
It is, yeah. What it does is take a short-term trend, like the last 12 days, and compare it to a longer-term trend, like the last 26 days.
Okay.
When the short-term trend crosses above the long-term trend, it flashes a buy signal. It reveals invisible shifts in the stock's energy before they fully show up in the daily price.
So a positive 6.18 means what?
It means the longer-term momentum is still firmly positive.
Okay, so the energy is good, but the price still has to navigate the actual market. Let's map out the battlegrounds here. Instead of rattling off a dozen price targets, let's conceptualize where the ceiling and the floor are right now.
Good approach.
Going up, the immediate ceiling it keeps bumping its head against is around $466. If it punches through that, it challenges the all-time high of $471. And if it clears the all-time high, it's open sky up to around $485. On the flip side, if the stock drops, it has an immediate safety net right around $447.
The first line of defense.
Exactly. If the floor falls out there and panic sets in, we're looking down at a much harder landing around $440 and then $429.
Yeah, the 429 level is critical.
The way I see this chart pattern, it's like a coiled spring. You have this massive long-term bullish energy, but right now it is consolidating. It is compressing in this really narrow range just below its all-time highs, just waiting for the next catalyst to launch it.
A coiled spring is a great way to put it, but remember, springs can snap violently in both directions.
That's a good point.
If it breaks below that $447 safety net, that built-up energy could trigger a cascade of algorithmic selling. The market is really just holding its breath right now.
Which brings us to the great debate. With the stock consolidating in this $450 range, the ultimate question for you listening is whether buying in here is a genuine bargain or a classic devastating value trap. Here's where it gets really interesting. Let's lay out the medium to long-term bull scenario for 2026 and 2027. The entire bull case hinges on Micron's HBM4 production.
Yep.
This is their next generation of high bandwidth memory, and it is entirely focused on feeding Nvidia's upcoming Vera Rubin platform.
And this is probably the single most critical piece of data in our entire stack of sources. Micron's entire 2026 capacity for HBM is already fully committed.
Right, entirely?
It is 100% sold out.
Sold out for the entire year. That is wild. You literally cannot call them up and buy more memory right now, no matter how much money you have.
The order books are closed.
So if the broader AI demand continues to outstrip the physical supply at this rate, Micron could theoretically still be severely undervalued, even sitting here at $450, right?
That is the ultimate bull case. You have guaranteed revenue, locked-in top-tier customers, and insatiable global demand. The cash flow is practically guaranteed for the next 12 months.
But I know there is a massive but coming.
There always is. If we connect this to the bigger picture, we have to look at the downside risks. Because no stock goes up 561% without immense risk trailing right behind it.
Okay, lay out the bear case for us.
The primary bear case revolves around the fact that memory chips, historically, are an incredibly cyclical business. They go through massive, violent boom and bust cycles.
Right, because memory isn't like a software subscription where the recurring revenue is locked in forever.
Exactly.
Once a data center buys the chips, they don't need more until they build another data center.
Precisely. It's a cyclical hardware upgrade cycle. If the broader AI infrastructure spending slows down even slightly, like if companies like Microsoft or Google decide they have enough server capacity for the next couple of quarters and hit pause,
Then what happens?
the demand for HBM drops instantaneously. Furthermore, you have fierce, deeply well-funded competitors like Samsung who are desperately trying to catch up in the HBM space.
And Samsung has deep pockets.
Very deep. If Samsung cracks the code and suddenly floods the market with a competing product, the supply shortage ends.
And that massive pricing power vanishes.
Poof. Gone. And those beautiful 58% profit margins get crushed back down to reality. If that happens, we could see a vicious sell the news re-rating of the stock.
And that leads perfectly into the warning for retail investors, because this exact scenario is where everyday traders often get completely trapped.
It is a devastating psychological trap.
How so?
Well, retail traders often log into their brokerage. They see a stock that is up 561% over the past year. They feel massive FOMO fear of missing out, and they buy right at the absolute top of the hype cycle.
Thinking it'll just do another 500% next year.
Right. They assume past performance guarantees future results. But they completely miss the underlying operational risks, specifically the incredibly aggressive capital expenditure we talked about earlier.
Right, the $5 billion they burned through in a single quarter just to build factories.
And it's actually much bigger than that when you look ahead. Micron has officially raised its fiscal year 2026 CapEx to over $25 billion.
$25 billion.
Yeah. Think about what that actually means structurally for the company. They are legally and operationally committed to spending $25 billion just to build new fabs and buy equipment.
That's a terrifying credit card bill to have hanging over your head if the AI party suddenly gets shut down by the cops.
That is exactly the risk.
Yeah.
If AI demand dips or if Samsung drives prices down, Micron's revenue shrinks rapidly. But that $25 billion bill still has to be paid regardless.
Wow.
That scenario would severely pressure their free cash flow, force them to take on massive debt, and it could devastate that bulletproof balance sheet we praised earlier. Retail investors often entirely ignore the fixed cost side of the equation when a stock is flying high.
That is a very sobering reality check. So, to pull all of this together, let's look at the two time horizons we are dealing with. In the short term, meaning the next few weeks, all eyes on Wall Street are firmly locked on the upcoming earnings report on July 1st, 2026.
Yeah, that's going to be a big one.
High volatility is practically guaranteed around that date. Analysts aren't just looking for good numbers anymore, they are demanding absolute perfection.
Totally.
Specifically, investors are going to be laser focused on those gross margins, watching to see if Micron can punch above that 81% guidance threshold for their highly specialized product lines.
And make no mistake, if they miss that 81% margin target, even by a fraction of a percent, the market algorithms could punish the stock severely.
Because it's priced for perfection.
Exactly. When a stock is priced for perfection, any slight deviation is treated as a disaster.
But long term, if you are looking years down the road, the play here is really a philosophical bet. It's a bet on whether this massive AI infrastructure spending has created a permanent foundational paradigm shift in how global technology works.
Or if we are just riding the peak of a temporary supercycle that will eventually revert to the mean.
Right. So what does this all mean for you listening right now?
Well, I want to be very clear. This natural debate we've been having, exploring the bull and the bear case, is purely an analysis of the financial data, the technical charts, and the sources we have in front of us.
Yeah, absolutely.
None of this should be taken as financial advice. You have to weigh these variables and make your own decisions.
The data presents a highly complex, high-stakes picture.
It really does. And as we wrap up, we've talked extensively about AI demand, the risk of a cyclical bust, and competitors like Samsung trying to flood the market. But here is something completely different to chew on.
Oh, a curveball.
A huge variable we haven't even touched yet. Almost all of this incredible HBM technology relies entirely on Taiwan Semiconductor TSMC manufacturing the actual advanced GPUs that Micron's memory ultimately plugs into.
Ah,
If global geopolitics shift even slightly in the South China Sea, disrupting TSMC's supply chain, does Micron's 100% sold-out capacity even matter if there are no processors to attach the memory to? It is the ultimate invisible bottleneck. You can have all the rocket fuel in the world, but if you can't build the rocket, the fuel just sits in the tank.
that is something serious to think about as you watch this stock. Thank you so much for joining us on this deep dive into Micron technology. Don't forget to hit that subscribe button, leave your feedback in the comments, and we'll see you on the next deep dive.